I just want to take a moment as the co-chair of the Australia UK Housing Network to acknowledge, of course, that many of us coming from the UK, from Australia, are dialing in from land that was never ceded. So I myself am dialing in from Darawal country. So I want to acknowledge and pay respect to the traditional custodians of the land I'm on today. And I'd invite anyone else who wants to do so to please acknowledge country in the chat. So this session is going to be chaired by my co-chair, Professor Mark Stevens. I'll hand over to him now.
Hello and welcome to this Australia UK Housing Network event. My name is Mark Stevens and I'm co-chair of the network. The Australia UK Housing Network is a collaborative initiative bringing together leading academics, policymakers and housing professionals from Australia and the UK. Our aim is to address shared housing challenges through cross-country dialogue, research and policy innovation. Recordings and summaries of our recent events, including housing and policy challenges, planning and house building, and critical junctures in housing policy, can be found on our website, which is curated by the UK Centre for Collaborative Housing Evidence, CASH, which provides our secretariat. Today's event addresses the emergence of the build-to-rent sector in Australia and the UK. In both countries, the private rented sector has been dominated by small-scale landlords, which are often characterised as being amateur and presiding over some very poor housing conditions, yet reluctant or unable to withstand the kind of protections that tenants should enjoy. Institutional investment and professional management have been seen by many as being a route to provide higher quality rental housing, and increasingly also as a means to increasing supply. We have two main speakers today, Alice Earley and Rupa Ganguli, who will be presenting findings from a Glasgow Sydney University project funded by the university's Collaborative Ignition Grant Scheme. Dr. Alice Earley is a research associate at CASH, based at the University of Glasgow. She is an interdisciplinary urban researcher whose research interests include the relationship between regeneration and gentrification, housing and inequalities, the role of social and community enterprise within different policy agendas, and community asset ownership and management. She completed her ESRC-funded PhD in urban studies at the University of Glasgow in 2020. Her thesis explored the role of community-based social enterprises and specifically their community-managed assets in regeneration and gentrification over time in England and Scotland. Prior to starting her role as a research associate in November 2022, Alice was a BSP Research Fellow at the Bartlett School of Planning at the University College London, a tutor in urban studies, public policy and qualitative methods at the University of Glasgow, and a research assistant at CASH. Prior to starting her PhD, Alice worked in public policy, regeneration and economic development, research consultancy in both London and in Glasgow. Our other speaker is Dr. Rupa Ganguli, who is an associate lecturer at Western Sydney's University's School of Business, teaching property, research and valuation subjects. She completed her PhD in 2022. Her doctoral thesis used an institutional lens to unravel the practices and key actors of the off-the-plan sales of strata title departments underpinning Sydney's post-GFC market cycle. She has subsequently worked as a postdoctoral researcher on the housing market-related projects funded by the Australian Research Council and by the Australian Housing and Urban Research Institute, AHURI. Her current research interests are in uncovering inefficiencies and risks in property market processes and practices to inform policy and regulatory change. Prior to transitioning to an academic career, Rupa worked in the property industry in various research and consulting roles, informing development and investment decision-making of public and private property sector clients. Alice will speak first, Rupa second, each for 20 minutes, and they will then sum up. We will then open the floor to Q&As and discussion. Other members of the team researching BTR, Nicola, Livingstone and Phil O'Brien, may join us at this point. If you think of a question whilst listening to the speakers, please do type it into the chat. So over to you, Alice.
Thanks very much, Mark. I'll just share my screen. Find the right presentation. Oh, there we go. It's moved. Okay, can you all see that okay? Yeah. Yeah. Okay, thanks. Thanks very much, Mark and Catherine, for the invitation to present. It's really good to be here this morning. So yes, I'm going to be looking at the UK side of things. I will start a timer as well to keep you on track. And so yes, the title is Institutional Investment in Build to Rent, Policies, Incentives and Contributions in the UK Housing Market. And as Mark mentioned, this project is part of, this project was funded by an ignition grant between the universities of Sydney and Glasgow. So it was led by Lawrence Troy at Sydney and by Phil O'Brien at Glasgow. And we were really interested in looking at the similarities and differences between the kind of housing emergencies and growing inequalities and crises, both in the UK and Australia. Both markets, as we know, have been historically dominated by home ownership, but are experiencing increasing difficulties in the home ownership sector with the growth in the PRS. We're particularly interested in looking at build to rent as well as PBSA, but we're focusing on build to rent today. Looking at kind of new forms of institutional investment opportunities for international capital and the impact that this would have or might be having on the housing markets in each country. We were interested in looking at the different actors from the state to market in recreating new forms of housing and lived experiences, unpacking perspectives through planning systems and also developers and investors. And we're interested in looking at the role of political agency, legislation and regulation in housing within this sector of the housing system. Today, I'm going to just briefly outline the aims and methods that we use for the project, and then discuss the kind of UK context in terms of the development of BTR before going into our interview data and bringing out some of the key themes. Then I'll hand over to Rupa, as Mark said, who will present the Australian case and then have some slides at the end, bringing the two case studies and national context together, drawing out some of the similarities and differences. So the aim for this part of the project was really to analyse the potential contribution of build to rent in the UK and Australia and the individual jurisdictions of the UK, and to explore the impact of the various incentives and varied policy environments in an international comparative perspective. Our methods have involved interviews with 29 key stakeholders, 15 in the UK, 14 in Australia, across 23 different interviews. So a couple of the interviews were held with more than one stakeholder. As well as this, we've also been doing some policy analysis, doing our best to keep up to date with the kind of ever-moving policy landscape in Australia and England and Scotland as two different policy environments for housing. And we've also looked at some case studies. So in the UK context, that has been Manchester and Glasgow, allowing us to look at the differences between the Scottish and English policy context. And in the Australian context, the focus has largely been on Sydney and Melbourne. So just to begin, just kind of thinking about the changes in the PRS more widely and what kind of led us to the situation that we're currently in today with the growth of the PRS and build to rent within that. In terms of supply factors, we've had both, and this is kind of relevant for both the UK and the Australian context. We've had long-term house price inflation with windfall gains for homeowners that have been used traditionally in buy-to-let landlording. Quantitative easing, however, reduced returns on gilts and savings, making the PRS more attractive. Since the global financial crisis, there's been kind of constraints on house building as a result of recession, with increasing crisis and costs. And there's been the growth of kind of short-term lets as a new sector within the PRS, which has taken properties out of the standard PRS sector, leading to shortages in housing availability and affordability issues as well. In terms of demand, there's been increasing house prices since the late 90s, tightened mortgage lending since the global financial crisis, and restricted access to owner occupation for lots of people who would have traditionally moved into that sector of the housing market. Alongside that, there's been student population growth, leading to investment in purpose-built student accommodation, and kind of changes in the urban population base, and associated debates around kind of studentification and what that's doing to local neighbourhoods. There's been a preference for density and high-rise living, trading off amenities and commuting against space and ownership. So these changes have really led to kind of a number of challenges for the PRS, of which, and within that kind of debate, build to rent has been put forward by some as one of the potential parts of the solution to some of these challenges. Just to briefly introduce purpose-built student accommodation in the UK. So this is really seen as the vanguard into institutional residential investment in the UK, with a huge growth over the past 20 years or so. And there's been significant institutional and significant institutional investment developing a specialist market, which is no longer seen as an alternative, but very much a mature market. 2020 saw the UK's largest ever property transaction and the biggest PBSA transaction globally to date, worth 5.22 billion euros. Just to give you an idea of the scale of PBSA in the UK context, this is the volume of investable PBSA in 2019 was 10 times that of BTR PRS property. So really highlights the different scales of the sectors. In 2023, the PBSA market was valued at £85 billion, and this was forecast to increase to £104 billion by 2028. But there are debates ongoing in the UK about whether or not we're kind of reaching saturation point, and particularly given changes in student numbers and the impact that that's having on the demand for purpose-built student accommodation. In terms of build to rent, then, the underlying case, as I mentioned or alluded to in the earlier slide, in terms of changes in the PRS, there's been a growth in the PRS, partly as a result of kind of the increasing costs within the owner-occupied market, meaning that lots of people who would have traditionally moved into owner occupation earlier in their lives are now having to wait longer to save up a deposit, or even kind of struggling to enter the that part of the market at all. Alongside that, within the UK context, there's been the residualisation and decrease in the social housing sector, which has meant that lots of people are living in the PRS who would not traditionally have done so in the kind of in the early days of the kind of UK welfare state. There's been discussions about buy-to-let landlords exiting the sector as interest rates have increased. And alongside that, tenants have been staying longer in the PRS, and this has resulted in 30% less properties being available to rent in 2020 compared to 2018-19. So that's really increased demand on the sector, and pushed up rents and associated challenges. So BTR within this context represents a new product that's sufficiently differentiated from buy-to-let PRS. Some of these developments have been built on brownfield sites, which are traditionally, which have been easier to get planning permission for, with some kind of incentives in different parts of the UK. And alongside this, the retail and office rental growth in the UK has been slowing, partly as a result of kind of post-COVID-19 changes. And so they're looking for new areas to invest in. However, within the BTR market in general, there are lots of differences, and different developments have very different kind of, they're very different products, essentially. The typical product in the UK is a small floor space, so that might be a studio apartment or a 1-2 bed apartment or flat, in medium and high-rise schemes, with the rent being about 10% plus of the standard market rent in that particular area. They're often in central locations with and attracting highly skilled urban singles and couples. There are a small minority of mid-market schemes aimed at key workers, which tend to have lower amenity and lower rents. There's been some office to residential conversions within particularly in the English context, which have led to a growth in these developments, but also have their associated challenges, which I'm sure Nicola may draw on later in the discussion. And there's been a growing kind of single family market in BTR as well. So these developments might be slightly on the edges of cities and peripheral locations, which are semi-detached and terrace housing, but still through the build to rent model. In terms of the single family BTR, then the rationale is very similar to the higher end schemes, targeting those who are unable to buy but still want to live in a nice area with good quality amenities around them. There's ambiguity around whether this is opportunistic. So this is seen from investors as a growing market and attracting genuine interest. But some of these units have been sold on to investors by house builders who are struggling with the owner-occupied market. And there's a quote there from one of our participants saying, the cynic might see that listed house builders need to get a certain amount of sales done within a certain time frame, and then they pull the emergency BTR chute in order to help them get those sales underway. So this graph here just shows BTR homes by stage of delivery, starting from Q2 of 2013 and going up to Q2 of 2024. So the light grey at the top are those within planning, purple are those with a detailed application, blue are those with detailed permission, green are under construction, and black are those that are completed. So you can see that the number of completions has been increasing over time, over the past 10 years or so. BTR kind of emerged initially in the early 2010s in the UK context, and kind of 14 years later, the sector is now made up of 116 complete BTR homes with a further 45,000 under construction and 101,000 in planning, according to the British Property Foundation. However, despite the progress that the sector has made, this is still a very small proportion of BTR homes available to the 5.5 million people who are in the private rented sector in the UK today. And so while there's been growth, it's still a reasonably small part of the market. As you can see from this chart here, so this is BTR is very much a growing but still modest proportion of UK institutional real estate investment. So you've got retail, office, industrial, hotel, other and residential there at the top. And from 2000 to 2023, this increased from 1.4 billion to 16.3 billion. The figure here shows the total UK BTR investment volumes in the UK. This is from a Knight Frank report from Q1 of 2025. And it's important to note here, so make sure I get my figures right here. So the operational stock in Australia reflects a market that's worth 5 million Australian dollars. So that's which is approximately a quarter of the value of BTR investments that were transacted in the UK in 2024. So that was 5 million UK pounds, which was 10 billion Australian dollars. And as I'll go on to discuss when we get onto the interview quotes, in the Scottish context, there's been a lot of policy uncertainty and political uncertainty, which our participants really emphasised had kind of affected the development of BTR within the Scottish context. And so while there are lots of developments in planning and approved, there's been a real kind of halt in terms of the actual completions since there's been discussions around the ongoing housing bill and particularly issues around kind of rent controls. So just to briefly outline some of the key literature in the UK context, there's really been debate around how far BTR can help address some of the issues around affordability. And so it's important to think about this within the kind of context of wider housing inequalities and whether or not BTR is actually going to help address any of that affordability issues, or whether actually this might contribute to exacerbating existing inequalities. There's also kind of challenges in terms of the policy. This quote here from Francis Brillen, Dan Durant, based on the London context, argues that BTR does not depart from many of the structural conditions evident in the existing private rental market, yet public policy, especially planning policy, has distinguished it as a new form of tenure. So just to briefly outline some of the kind of policy influences and also influences on UK policy, it's important, as we've discussed in previous presentations for this network, to highlight the differences between the Scottish and Westminster policy approaches. There's been changes in England since the election last year when the Labour government came back to power. They've set a target for 1.5 million new homes in the next 5 years, with an emphasis on kind of the increasing development in new towns. There's been a shift from the Renters Reform Bill under the previous Conservative government to the Renters' Rights Bill, so trying to strengthen rights for tenants. There's been a revision of the National Planning Policy Framework, which officially recognises BTR as a distinct housing category. There's been changes in terms of building safety as a result of real atrocities within the country in the Grenfell Tower disaster. So really trying to increase security and safety for high-rise buildings. And there's been changes in rent regulations in Scotland, as I mentioned, and reforms proposed under the current Housing Scotland Bill, which are potentially challenging BTR viability, although at present the aim is for build-to-rent and mid-market properties to be exempt from these regulations. It's important to recognise the subnational governance and devolution issues and challenges across the UK and the impact that that has on policy. Across the UK, we've got issues of affordability and kind of debates around developer contributions within developments, and there's challenges within the planning system, which I'll go on to discuss. So just to move on to the interview data then, within the Scottish and English context, there was real discussion amongst our participants around kind of promoting the idea of BTR to institutional funds to really try and see it as one of the potential solutions to the housing supply issue. And the feeling was that good quality BTR, as this person said, could really professionalise the sector, bring up the standards of PRS housing as it had done in other countries, looking to places like Germany, France, parts of the US and Sweden. And as this participant really emphasised, there's pretty much, broadly speaking, a massive supply-demand imbalance. So BTR was seen as very attractive in that respect in terms of being able to contribute to the housing supply shortages. Within the, particularly in the Manchester context, and within Manchester, there's a Greater Manchester Combined Authority, a very strong kind of regional level of governance, and that there was a view that this structure was very proactive, and they've been very forward-thinking about trying to address the housing crisis in Manchester, and so they've been very much supportive of BTR as a part of the PRS, and ensuring that people had really good quality private rented accommodation within the city. There's also been support from central government since the Labour government came into power, and this participant here described how they think that the government really sees build to rent as a significant part of achieving the kind of housing building targets. And these participants didn't see any reason why there couldn't be more growth within the sector going forward. In the Scottish context, participants were slightly less optimistic, I think it's fair to say. And this participant here was talking about the Glasgow context and saying they'd seen a real downturn in terms of mainstream housing to BTR, from a move from BTR to PBSA. And that was largely due to kind of the national policy context and some of the viability issues that participants discussed. And this was seen as kind of a challenge because they were really trying to promote city centre living, but it was difficult to get BTR developments within the city centre in Glasgow. As I mentioned, there's been a lot of discussion and uncertainty about rent control, and two of the participants here kind of talked about the politics of the situation being the key concern. So on the one hand, there's investors are interested in the Scottish context, but on the other hand, it's just difficult to navigate that policy uncertainty. And so another participant described the housing policy around rent controls really putting this degree of risk in the quite difficult to land category, and again talked about developments that were initially put forward as BTR developments and being flipped over to PBSA. Obviously, this is a very long quote, which I won't read out in full, but I think it's important to recognise again the kind of different legislative dimension. And in Scotland, we've got a different tenancy regime with tenants only needing to give 28 days notice, which participants highlighted caused some uncertainty for investors and developers without just something that was different to the English context and something that was kind of causing a level of nervousness. There's also issues around the politics and issues about concerns about independence and what impact that might have on the context. And on the other hand, they said, there's still plenty of land in Manchester and Bristol and Liverpool where they don't have the same restrictions. So you could argue, why would they potentially why would they invest in Scotland? In England, participants talked about the changes in terms of policy in terms of the Building Safety Act and the impact that was having in terms of the planning pipeline and development pipelines. Also about the Renters Reform Act and the impact that was having on the rental market, as well as viability concerns. I'm conscious of the time, so we'll try get through the next few slides very quickly. In the UK context, as I've mentioned, there was clear funding and viability challenges, and the issue of risk, as well as kind of, the increasing building costs and the impact that was having on developments and their viability. They talked about issues in terms of land costs and development costs and Section 106 requirements, so that's planning obligations in the English context, which can affect the viability of developments. Another participant described how planning regulations aren't necessarily set up for the build-to-rent model, whereas it's set up for the kind of traditional private rented accommodation, and that can be a challenge. And then just finally to end, before I hand over to Rupa, I think the real question here that's been emerging from our participants is really this question of affordability and build-to-rent being promoted by some as a panacea for addressing issues in terms of the housing crisis and affordability, but actually whether that's really viable in terms of the amount of kind of government grants that are available to help support it, and also the kind of returns on investment that different investors are looking for. So that's the end of my presentation. Thanks very much for listening, and I will hand over to Rupa now.
Thanks, Alice. Can everyone hear me? Yep. Okay, good. Thank you. And I will sort of explain that I did start working at University of Sydney on this project and recently moved to Western Sydney University, which is why you'll see the Western Sydney University logo on the presentation slides. I'd like to acknowledge that I'm presenting from Boromadigal, or Parramatta, the land of the Darug people. Boromadigal means where the eels lie down. And I'd like to acknowledge the traditional custodians of the land on which we teach, learn and research, and pay my respects to the elders past, present and emerging. So in my presentation, I'll focus on the build-to-rent sector in Australia, which is definitely in its infancy compared to the UK, and focus on the policy levers that are creating opportunities for growth in the sector, but also some of the challenges that the sector faces in going forward. So the body of research is gradually building in Australia, and some of the key themes that have been commented on in existing academic literature is that the large corporate landlord sector, or the multifamily sector, or build-to-rent sector is in its infancy in Australia in comparison to the US, Canada, UK, and other European countries. Most of the stock in Australia that has been completed so far has been new builds rather than conversions or renovations of existing buildings. We're not quite seeing the growth of mid-market supply or single-family rental that we are seeing abroad, although there was some mention of potential growth of those two subsectors of build-to-rent in Australia amongst the interviewees. Build-to-rent still a very less than 5% of the PRS housing stock in Australia, and most of the private rental sector is dominated by individual investor landlord households. The key issues or barriers to growth have been development feasibility, similar to the UK, and the two key themes are market conditions don't support that development feasibility or financial viability, and constraints in relation to policy settings. Certainly, a number of reports have highlighted that build to rent will not be the solution to housing affordability, and it won't be successful in growing as a sizable sector unless there are government subsidies and planning policy concessions and taxation policy concessions made available. However, the positives will range from providing more housing diversity, improving construction management standards, and providing more secure rental housing. It's been well recognised by Megan Nethercote in multiple publications that it is a global financialised asset class, and there are private sector beneficiaries in Australia, and this has been charted globally as well, where this type of housing typology has grown. So we have, like the UK, we've seen a rise in the share of households living in the private rental sector, which is represented by the black component of the chart, and that the affordability challenges in the rental as well as the sales sector has prompted the government to look at solutions to increase housing. And one part of that solution is to increase housing diversity, and build to rent is part of that housing solution. The other, I suppose, drivers of change has been market failure in the build to sell apartment market, particularly, which experienced a big boom bust cycle following the global financial crisis, and we've had significant challenges in construction quality and addressing of building defects. So there's been significant reform on that front, but there's also been reform on professionalisation of the sector and introduction of rental reform as well to protect the rights of tenants. So we have seen multi-unit dwelling supply moderate post-GFC, which is, again, according to the property industry, placed upward pressure on rents and prices as well. So in terms of build-to-rent supply, it only comprises, so in terms of quantum of operating units, it makes up just above 11,000 build-to-rent units, and it really depends. It's generally the property industry or grey literature that's charting the quantum of completed stock. And there is a sizable pipeline predicted by the various different consulting firms and real estate agency firms. And most of that stock, both completed as well as in the pipeline, is located in capital city locations. There are a number of regional projects that are being worked on by state government developers like Landcom in New South Wales, but they're predominantly dominated in Sydney, Melbourne and Brisbane across the eastern seaboard, but there will be a rising share of build-to-rent stock in other capital cities like Canberra, Adelaide and Perth going forward. And these are just some examples of build-to-rent projects in Australia. The very first one is the Smith Collective site, the former Gold Coast Commonwealth Games Athletes Village. It was originally built by UBS Grocon, and then the ownership handed over to Abu Dhabi Investment Authority. And recently the management rights have been purchased by Local for an estimated 600 million. We've also got Mirvac, who were one of the first institution or listed entity to start building a portfolio of build-to-rent units, and they were funded by the Clean Energy Finance Corporation as well. Their portfolio now is 2,000 apartments, and only 6% of those are affordable at this stage. They were the first movers, so I suppose they weren't able to benefit from some of the density bonuses that have been introduced in projects, particularly ones that can demonstrate their provision of affordable housing. And then the other sort of blurred line or grey area is the provision of build-to-rent housing in the build-to-sell apartment market. So Meriton has been a sizable developer in the build-to-sell market, but they're also have a decent amount of stock that they rent out to households as well within the build to sell space, and they're now branding their business, service department business, or build to rent business separately to enter into this market as well. And we've seen build to sell developers pivot to build to rent as well, given that it's been a challenging market to sell apartments off the plan as well. It's been well established that build to rent rents in build to rent buildings, advertised rents in this case on the left hand side are at a premium to median rents advertised in the overall area. So there's a rental premium over existing rental stock, and it will not present as an affordable rental housing kind of solution, certainly the market rental component of those buildings. And they're also commanding a premium over built to sell apartments. So one of the recent rental listings for a Mirvax building, for example, in Olympic Park, the quoted rent was $1,075 per week for a 2-bedroom apartment, which is quite rich. The other, I suppose, triggers to attracting capital into the build to rent sector, or generally in the living sector, is that build to rent yields are low and stable. So they are attractive for pension funds or Australian super funds who are looking for long, stable rental returns, and they're not deterred by the relatively low investment yields offered by build to rent compared to more lucrative capital rates offered by non-residential asset classes. So investors looking at the living sectors are always looking at a spread between the bond rate, 10-year bond rate, and capital rates in respective asset classes. And the 10-year bond rate in Australia at the moment is 4.29% in October. So build to rent is a relatively low risk proposition in their view. And there's increasing global investor appetite in the residential sector. Build to rent obviously is one of the overall living sector asset class, which includes retirement villages, land lease communities, purpose-built student accommodation. But investors are wanting to diversify geographically as well as their returns risk profile. They're also looking at other assets like data centers and farms and wind farms as examples. So build to rent is one of other alternative asset classes that typical investors who've invested in office, industrial and retail buildings are pivoting towards. So turning to some of the interview findings, first the tax and planning policy changes that have created opportunities for growth in this sector. What has triggered it, I suppose, similar to what has occurred in the UK, the Montague Review that occurred in 2012 has been a report issued by the federal government, by the Interim National Housing Supply and Affordability Council, highlighting recommendations in 3 areas. We need to increase a larger pipeline of projects to expand the stock of private rental housing, not just private rental housing, but also rental housing provided by public institutions. There's a need to de-risk development and ownership of institutional housing. There's a need to attract institutional capital into that sector to provide both public and private housing, and there's scope to increase supply, not just in the built to rent sector, but other sectors such as purpose-built student accommodation, residential aged care. The key barriers highlighted in the report and also emerge in our interviews is the inadequate risk-adjusted returns, the lack of existing market scale and transactional evidence to support returns, expectations, and the restrictive and complex policy and regulatory environment in Australia. So we've seen a number of different federal and state government policies and agencies established to expedite that supply coming on board, and they've been, and I'll focus on the taxation and planning policy levers. So we've had the National Housing Accord, which has set an ambitious target of 1.2 million new well-located homes out to June 2029, including a nominal 20,000 affordable homes. And then a housing, greater funding from the federal and state government allocated to the delivery of private as well as social and affordable rental housing going forward. We've also had the Housing Australia Future Fund and a new legislation as well to deliver and administer the delivery of that housing. But there's been contention in the property industry and amongst the interviewees as well. They're doubtful that the National Housing Accord dwelling target will actually be achieved. And there's also been debate around whether that initial target of 20,000 affordable homes, 20,000 new social homes and 10,000 new affordable homes was ambitious enough. So there's a couple of planning policy opportunities that have been created for the sector. Certainly in Victoria, which was described as the first mover in the build-to-rent sector, they've had a pro-development planning minister and the planning approval decision-making power taken over by the minister and expedited to the state level and away from local authority decision-making power. And this has been rolled out in New South Wales as well through the establishment of the Housing Development Authority. And then Victoria does not have an apartment build-to-rent design guide like the one introduced in New South Wales. In New South Wales, we've had the introduction of build-to-rent as a housing typology within the state planning instrument. And there's flexibility around the application of the apartment design guide. So developers don't necessarily have to provide sizable apartments or a lot of storage in apartments or balcony space, for example, because in build-to-rent buildings, there is a sizable proportion of common areas provided for those residents as well. Build-to-rent's also been permitted in commercial core commercial centre zones, and then we've had a state significant development pathway to expedite the approval of projects as well. So a number of interviewees commented favourably about these planning reform and enabling the I suppose, conversion of development schemes that were originally planned as office buildings into build-to-rent developments, because post-pandemic particularly, the returns from the office sector as well as the retail sector have been relatively weak compared to industrial and residential, for example. And then we had one interviewee, interestingly, talk about it being much easier to flick back to commercial as opposed to if your building was made residential strata title, you'd never be able to flick it back to commercial in terms of retrofitting it. And this, I assume, they're talking about beyond the 15-year timeframe within which the build-to-rent project has to operate and be under single ownership to benefit from tax concessions. Similarly, we've had land tax concessions introduced. So turning to the tax policy levers that have been used by the government to reduce the burden of holding sizable land parcels during the acquisition as well as land holding period. So in New South Wales, we've had a 50% land tax concession introduced until 2039, and then recently they've removed that end date for that concession. Similarly, in Victoria, we've had that similar type of land tax concession up to 30-year period. And then Victoria has been the most burdensome in terms of land tax. They've had a land tax, in addition, a 4% foreign absentee owner charge, as well as a 1% vacant residential land tax as well. So they're trying to loosen some of those restrictions, particularly to attract foreign owners. WA has seen a 50% land tax concession also introduced, and Queensland as well, a land tax concession, as well as some concessionary arrangements for foreign purchases of land for build-to-rent projects. We've also had relaxation of foreign investment rules around build-to-rent acquisitions. This particular quote talks about how the build-to-rent sector in Australia has really come about because of the influx of global capital that has been familiar with investing in build-to-rent projects in other international jurisdictions. They're familiar with that asset class, and Australian policy has a policy landscape is similar to their home countries. So build-to-rent is exempt from the recent government ban on foreign entities purchasing existing residential properties. So foreign persons can purchase existing build-to-rent projects where the development will continue to operate as a build-to-rent project over a certain time frame, and investments in established build-to-rent projects could qualify for lower application fees at commercial land rates as well. Then in addition to that, and this received the most the most sizable interviewee references, the introduction of MIT tax concessions. So a new legislation being passed and an introduction of income tax definitions as well. So essentially, manage investment trusts holding build-to-rent assets, particularly foreign entities, were subject to a 30% tax rate on unit distributions, and that's been cut in half. So fund payments made to genuine foreign investors in build-to-rent developments will benefit from this tax concession, and the capital works deduction rate as well has been shifted up from 2.5 to 4%, but of course there are some criteria around what specific build-to-rent projects can leverage off these these tax concessions. They need to be providing at least 10% affordable dwellings within those projects. Alongside that has been the introduction of income. So what is defined as affordable in these projects? So the Income Tax Assessment Build-to-Rent Developments Determination Act defines what is affordable and who is a moderate income and lower income household. So there's sort of strict criteria, and previously the industry has argued that there's no clear definition of what is affordable, and even in our interviews there was some discussion about disconnect between federal definition and state level definitions. But in general, there was some positive commentary about institutional capital looking favourably upon the delivery of affordable housing. It ticks the ESG benefits. The market response is really strong. There's massive demand for affordable housing, but there were some constraints that were considered as well, which I'll turn to in a second. The other positive, I suppose, aspect is that the intention to salt and pepper affordable apartments through the building, and the intention to deliver tenure blind buildings and all apartments built identically, and all tenants having access to the same services suggests that there will be equal access to apartments and no discrimination against those affordable, tenants of affordable apartments. And then the other opportunity created by these policy levers, I suppose, is ability to deliver projects at economies of scale. And there was description of large-scale projects as well as mid-scale projects, which are attractive for that global capital who are looking for to invest in scale. Institutional groups want scale. They don't want to just write checks for like 20 million or 30 million. You talk to Blackstone, they want to write a check for 500 million. They were looking for avenues where to park capital. So there was a lot of discussion about significant foreign appetite to invest in build-to-rent, rather than the Australian superannuation funds who were more focused on delivering social and affordable housing projects and were investing offshore on build-to-rent projects. So turning to constraints and financial viability, similar to the UK context, there was quite a lot of discussion about the IRRs, one of the benchmarks used to assess the financial viability of projects, being insufficient to justify moving forward. The high cost impost still related to purchasing land in prime locations close to public transport or inner city locations in capital cities was a key deterrent that was talked about, as well as costs associated with delays in securing planning approval. And then the other metrics that kept getting talked about is capitalization rates or rental yields, very little transactional activity to support assumptions around discount cash flow modeling as well. I won't go through these two sizable quotes, but essentially they were talking about the difficulty in competing with build-to-sell developers and other build-to-rent developers in securing sites in prime location, and particular challenges in securing development approval in the New South Wales context, in Sydney particularly, where planning approval delays were adding to risk associated with projects and holding costs for projects as well. Projects were just not viable unless a high rental revenues were sort of assumed at the upfront level, as well as fairly ambitious rental escalation rates during the hold periods of projects as well. So there was numerous references to feasibility for build to rent being very challenging unless there was a rental premium attached to projects. There was very little mention of the appetite to deliver mid-market type projects. And there seemed to be a connection with premium rentals and the provision of high level of amenity in buildings. There was discussion about uncertainty around tax settings, complexity of the tax landscape between federal and state government, and the cost imposts associated with land tax. There was also mention of unfavorable GST concessions in the build-to-rent sector compared to the build-to-sell sector, and Melbourne being an early adopter or seeing a significant pipeline in relation to the other states because the government was more favourable in terms of planning approvals as well as land tax concessions. And then there's potential for high market rents and mixed tenure build-to-rent buildings, which was interesting. This one, this quote, there's obviously the MIT Investment Trust side of things. It's a good step in the right direction. Obviously, though, it comes with the condition that you have to provide affordable housing, and the build-to-rent operator, a developer, needs to work with a community housing provider to manage that affordable housing. But they were wanting to ensure a consistent brand, not to dilute that brand, and that CHP operator adding to unnecessary cost, which then would be passed on to higher rents for the market rental housing as well. And the other concerning aspect was that some interviewees talking about screening for professional tenants, and these professional tenants were described as gaming the system and hopping from apartment to apartment and not paying rent, and being difficult to evict. So they were using, renter screening, and there were obviously these operator integrated models where the operators were, also the developers were using renter screening to vet for risky tenants, and to try and avoid turnover in their buildings as well, which then also creates an issue of privacy. So planning policy challenges, one of the key, Sydney kept being brought up as very difficult to build to rent buildings, the protracted planning approval process, and difficulty to pick up sites quickly, and then this preference for developers to purchase DA approved sites, which are obviously expensive, and then capital investors as well, wanting to hold stable assets, and not a lot of developers and investors coming into Australia not wanting to take up development risk and buy existing assets, stabilized assets as well. So there are few builders and developers that are taking on the development risk in Australia to provide those stabilized assets to the market for that increasing global investor appetite. So almost to the end here, I suppose this is more a provocation. Are we seeing early signs of potential downsides that were highlighted in the interim National Housing Supply and Affordability Council? And they were drawing upon existing academic research as well. Most institutional investors are profit maximizing entities. their interests are in making profit, and the delivery of their housing is not necessarily going to benefit the lower income cohorts. And as Megan Nethercote has highlighted, it has become an institutional asset class. Are we seeing those same warning signs appear in Australia that have occurred abroad? So this is where Nicola, Alison, Phil can pipe in. I'll finish off with a sum up. So the common challenges that we're seeing across UK and Australia: funding and financial viability, despite policy levers making it more lucrative for investors and developers to enter this space. High costs of land, high cost of construction, unpredictability of build costs, high rental revenue required to offset costs kept coming up in both jurisdictions. It's considered risky by institutional investors due to the need to generate long-term income. Obviously, the question of affordability and delivery of long-term affordable housing outcomes. How are these outcomes going to be quantified and monitored by the federal and state government regulatory bodies? And who will actually benefit? Will the affordable rentals continue to remain affordable in perpetuity? Are the rights of tenants being properly being monitored and accounted for, even in the market rental segment of these buildings? Planning challenges, long approval times, creating uncertainty, kept being brought up, particularly in the New South Wales context. In Australia, planning systems not designed for delivery of build-to-rent housing, rather private housing alongside affordable housing. So delivery of mixed tenure projects is a challenge. Future prospects for the UK, issues going forward: rental growth, slowing rental growth, which obviously impacts your capitalisation rates or yields. Build and debt costs not abating as quickly as expected, many easier sites built out already, and policy and political risks, which Alice touched upon. And then possible future trends are single family rental housing, growth in that sort of segment, and possibly a few big deals, so maybe not representative, but interesting. Could be, is it a temporary phenomenon? We're certainly not seeing that in Australia as yet. The delivery of mid-market, lower amenity buildings has lower operational costs and turnover rate, and possibly a large tenant pool. This is starting to be mentioned in Australia, and there's scope for growth in Australia away from the focus on premium grade buildings. Australia issues going forward, just summing up what I've just talked about: financial viability and the cost of risk mitigation, investor hesitancy, and capital. Another key risk with the debate around whether or not commercial office sector is bouncing back now. Rental growth is rising in the office sector. Rental vacancy rates are tightening. So will capital flow back into the commercial office space and retail space as those property subsector performances bounce back? Build-to-rent developers are currently unable to claim GST credits on land acquisition, construction, and other development costs, which build-to-sell developers can do. And continuing possible future trends, the build-to-sell market downturn, low pre-sales volumes and profit margin could continue to encourage build-to-sell developers to pivot to build-to-rent. There is opportunity, obviously, with continued low rental vacancy rates and housing undersupply, and that need to deliver 1.2 million homes to propel investors and developers into build-to-rent. And of course, fairly generous planning concessions have been introduced for the delivery of mixed tenure projects, build-to-rent projects incorporating at least 10% affordable homes. So that's my list of references, and I welcome any questions. We welcome any questions and feedback. I send my apologies on behalf. Lawrence Troy is on long service leave. He's obviously the project lead in the Australian context, so stepping in and presenting instead of co-presenting today. So thank you for attending and listening. The floor is open for questions.
Okay,
Stop
well,
sharing my slides.
thank you very much, Rupa and Alice, for your excellent and insightful presentations. So yes, the floor is open for Q&A. or any points people want to make. And I think Phil and Nicola might be chipping in as well. In the chat, Catherine Gilbert has asked a question, which she lodged early on in the presentation. So I think some of the points may have been addressed. But Catherine, would you like to sort of reframe that in the light of having
Sure.
the entire presentation?
Thanks, Mark. So it was actually listening to Alice's presentation. There was a reference to, a particular segment of build to rent that's sort of targeted at the key worker market. I was quite interested by that just because I think in Australia there's a lot of talk about build to rent linked to, I guess, the growing spatial mismatch between where sort of moderate income, particularly essential workers, can live and where they're needed professionally. And so I guess there's a lot of hope that build to rent is a good response to that issue. So I was wondering, in the case of these particular developments that you've captured in your study, I was interested in when you said they were sort of, I guess, mid-market. I was wondering if that was like formerly a tenure that's regulated with set rents, or if this is more like low-cost rental housing that's otherwise just operating within the market. And then the second part of the question was whether there's any emerging evidence yet as to whether that's actually helping with that spatial mismatch and the recruitment and retention problems that, major hospitals and things like that are having.
Hi, sorry, I was just making a note of the 2 points. Thanks very much, Catherine. So yeah, Nicola and Phil, feel free to jump in. So in the Scottish context, mid-market rent is a specific housing development tenure model, which I forget the precise definition of. Phil might be able to jump in and help me out. But yeah, so it's rents at a certain percentage of the kind of average. In the English context, I think it just refers more to the kind of lower end of the kind of rental market. In terms of the evidence regarding help with, the impact that those developments are having, I'm not entirely sure. I don't know if Phil and Nicola have got anything to add on that. I think it's a lot of it's talk, like you say in the Australian context. I think there's kind of speculation, but how much evidence there is, I'm not sure. But Phil, go ahead.
No, so I don't think there's enough that you could say, anything like enough that you could say there is. I think it's happening. So in the pattern of where built to rent is built across cities in the UK seems to be that in regional cities, so Manchester in a big way, all in the city centre. Glasgow, what little there is, it's in the city centre. The odd scheme outside of the centre, so Edinburgh, we visited one up towards Leeds, up towards the water. So yeah, I don't know what that would be, something like 10, less than 10k outside the centre. London, it's not just land costs exist in built environment kind of prohibit that. So you're seeing it in kind of a ring in the inner suburbs. In London, you are seeing this kind of key worker stuff. In Manchester, we certainly heard talk of it. There's one or two schemes being done. I don't think it's at any kind of scale that you could say it's actually pretty measurable in terms of having the impact that you're talking about. I think the way you'd have to interpret it would be, because a lot of the stuff in the Aussie case as well that we were kind of looking at was, is there any scope for build to rent building at anything other than the sort of highest possible sort of rent decile? And I think you would interpret this kind of key worker type stuff in that context, where developers, investors would do it if they feel that that's a rental bracket that they're a part of the market that they feel that they can bring in profits from, and B, if it's viable. Because the stuff, I mean, especially the stuff that Rupa was talking about there was where the build to rent is viable. And if you've got, so UK bond yields, 10 and 30-year yields are demonstrably higher than Aussie 10 and 30-year yields. So the discount rate is higher in the UK. Materials costs, I don't know if they're that much different between the two countries, but either way, they've increased really rapidly. So all of these BTR projects hinge very clearly on you know, fairly ambitious rental growth. So whether they can build them out while while aiming for kind of a slightly lower segment of the market, slightly cheaper rents, is a big question. In Scotland, you've also got the rent regulation context, which Alice was talking about. So where we're up to at that with that now is that the Housing Scotland bill has passed its kind of the stage 3 reading. So it's into law now, but it's not into policy. So within the bill, there is framed the ability of policymakers to set an exemption, and that it's rumored will happen for a student, which makes sense, probably expected it. What Alice was talking about, mid-market, which is an affordable product, not kind of socially rented at the very low level, but a fraction of the I don't know if it is the mean of the market. I think it's actually set by the housing associations, but it's more or less that. And for BTR, but we're yet to see what happens at the policy kind of stage. So no, sorry, to come back to your question, I think it's really hard to see where we are with this. And it's also really hard to see more broadly whether we'll see BTR built at something closer to kind of average rents rather than just at the kind of top end of the market. Is that fairly accurate?
Yeah, I mean, I think in Sydney there have been some sort of below, like, discount to market rent projects, but they're so geographically confined, and that there's one sort of sweet spot where that's actually viable. We haven't seen them widely. But sorry, I don't want to dominate the question period. I do have other questions, but I'm happy to open it up to others.
I was just going to say as well, Catherine, that in England, in Manchester and London, you know, you've got your housing associations that are providing, you know, more affordable, smaller scale, what you would consider to be BTR, but then the institutional investors, as Phil said, are not really stepping up to that. You do have large scale, so for example, L&Q, who are a developer, but also they provide in London, you know, affordable, they also have social rent as well. Social, affordable, and what they call intermediate level rents in London, which is kind of your mid-market rent equivalent in Scotland. But they have, of course, certain criteria that you have to meet in order to qualify for this reduced rent. So their living rent in London, for example, you know, you've got to be a renter. You can't own any other property. Your household income has to be less than £60,000, which is what, about $120,000. So, you know, it's still, it's addressing a certain point in the market, but they also have affordable offerings, but delivered in a different way, I would say. And again, it's what we kind of try and classify as being build to rent and how we understand build to rent. But they would be a bit more of a larger scale, more institutional oriented type developer, compared to some of the smaller housing associations. There's one called First Choice Housing in Oldham, just outside Manchester. And they, you know, have delivered some smaller scale, affordable tenure, which could be considered build to rent because it's, you know, 14, 15 flats in a small scale development. So again, different actors with different priorities, you know, responding to the market in different ways. But the more affordable is more peripheral, as just to reinforce Phil's point. You know, it's accessible, and we've heard from institutional investors and people that we've spoken to that certainly there's appetite to extend, and there is capacity and a possibility to extend into more affordable provision. But I think it's kind of around that conversation and that broader piece around transport oriented development and making sure that if we're providing for key workers, they're in places that people want to live and that they can do the jobs that they need to do in an efficient way. But so much
one more thing on that would be the single family angle. So
single family as well, Phil.
There's so many terms, it's ridiculous here. So that, like, I think mid-market's been used in reference to just like the middle of the market, which I think is what you were suggesting, Catherine, but it's also that specific affordable product in Scotland only, not in England. Like, it's crazy. But single family and multifamily are US terms, so terms that we've just kind of imported. BTR, I think we came up with is it from the Montague report? I'm not sure.
The Montague report.
Yeah, somebody came up with it, then it's stuck, but it's kind of an annoying term. The single family stuff is basically built to rent, but housing as opposed to flats, which Alice was on about, and it's so typically built on much cheaper land. Fringes of Greater Manchester have got loads of this, and coincidentally or not, I'm not entirely sure, but rental growth in the outlying local authorities of Greater Manchester has been amazing. It's been like growth, not absolute levels, but it's been at like Southeast of England levels. Past 10 years, it's grown enormously. And that's probably just like people filtering out from the centre of Manchester and moving further out. So it's a part of the UK that's had plenty of jobs growth, as you know. The single family stuff is probably targeted at people who 15 years ago, maybe 10 years ago, would have been able to buy a house and now out of the market. The deposits just so great. Quite deposits so great. So that stuff probably is targeted at teachers, nurses in a smaller city than London. Your connectivity is not as big an issue. So yeah, I think that's probably taken up a lot of that segment of the market.
Can I just speak to permitted development rights for a minute as well? I know Alice mentioned this is not something that is prevalent or an issue in the Australian context. And I know a couple of the Australian interviewees talked about this and that there would just be too much of a kind of cost impact in converting, say, offices to resi, and that it's not really a pressing issue in the Australian market. And I hope that it doesn't become a pressing issue in the Australian market, because one of the issues that we've seen with poorer quality, what is again being termed as build to rent coming into the market in London, especially in areas like Croydon, has been due to this planning deregulation with permitted development, where you don't have to go through full planning permission to convert an office building into residential units. And there have been serious concerns about the quality being produced, but there's not really anything that you can do in terms of enforceability. So some of these are being defined as being build to rent, but they're very, very limited, and they're potentially compromising on that quality as well. And again, locationally, they're not going to be in prime areas. So that's a bit of an issue in the UK market, much more so than in Australia. It's not a direction of travel you want to think about going down.
Okay. Could I just jump in at this point? If anyone else has a question or wants to make a point, then please do use your raise your hand function. And whilst you might be thinking about that, I wanted to ask a question, and that's concerns build to rent from a public policy perspective. So what I'm interested in is BTR as a lobby group. So one question is it a homogenous group? Do they have the same kind of asks from government? Is this an effective lobbyist? Because there's been quite a lot about concessions on land tax, questions about GST in Australia, a vociferous lobby in Scotland but to be excluded from rent regulation. And if I could also invite you to put yourself in the position of being a politician, and to say, well, do you really believe them? What do they have to offer from a public policy perspective?
I'm happy to kick off because I worked in the dark side, on the dark side rather, and actually wrote a blog while as a head of research at JLL back in 2015, asking the question: will the residential sector become an institutional asset class? And raising the point, we've got rental housing unaffordability, supply constraints, tight rental market, and pointing to the fact that it had been lucrative offshore. And then after that blog, many clients calling me saying, this is what, we are interested in this and we're doing projects overseas, but these are all the tax barriers that are in place in Australia, which are making it difficult. And subsequent to that, we're seeing all those complaints addressed by government. And now the latest complaint is about the GST. So they're wanting the planning concessions, they're wanting the tax concessions, they want the development uplift, but at the same time, they are concerned about this brand dilution, managing the affordable housing component in a primarily market rental building, working with CHPs. So yes, they are a powerful lobby. The Property Council of Australia is a powerful lobby and has established a build to rent committee, and they are very much in the ears of state and federal government and have pushed this MIT tax concession legislation and reform, because, you know, most of the capital coming into Australia and looking at investing in PBSA, build to rent, or these living sectors are from offshore. So they're and the types of capital we talked about in the Australian workshop, it's sovereign wealth funds, pension funds, superannuation funds, private equity, other key sort of types of groups alongside the major banks. And these developers have, some of them are international, some of them are national, and a lot of the developers have experience in delivering residential but commercial buildings and have hold buildings in real estate investment, you know, listed and unlisted vehicles as well. So it's a risk diversification, hedging of risk play as well for them.
Okay, and if you were a politician, would you be skeptical, or do you think
Yes,
they're
definitely.
Right, okay.
Definitely. I think the regulators need to be aware. I think they're sort of going into with rose-colored glasses, thinking, oh, it's going to, you know, it's going to solve a lot of problems which we've seen in the build-to-sell sector, but we're not really seeing concern about the tenants, satisfaction of tenants living in these buildings, and displacement of tenants, and potential rent escalations they face. There's certainly discussion in our interviews about the opportunity to command higher rents when there is turnover in buildings and new tenants sign leases, and managing that with more moderate rent escalations among sitting tenants, and the assumptions around development feasibility about asking rents from you know, completion of building and rent escalations. They're very ambitious. No one's really concerned about supply side gluts in fairly confined geographies, and that monopolization of rental power of these institutional landlords in fairly confined geographies as well.
Okay, thank you very much. Could we have a quick response from one of the UK team, and then we have a question from Shah?
Yeah, I can jump in. So, I mean, in terms of the effectiveness and homogeneity thing, I mean, Scotland would be an interesting case. There's not a lot of it. The provision is a very limited number of developer operators. So the way they typically operate is a developer will build out, will take some sort of forward funding and investment from investors, so typically a pension fund or an insurer. They'll often keep some equity themselves. They will continue to operate once it's developed. And sometimes that'll be like a 10-year holding period and it'll sell to another investor. Sometimes there's an intention to keep it for longer than that. So especially in Scotland, where you've had the kind of rent regulation issues, the investors have typically been in it for the long haul to, you know, to get over that. You can, so yeah, homogeneity, yes, very homogeneous, very limited number of operators. Could be just the stage of the market, stage of development we're at. Effectiveness, we'll look at the lobbying with regard to rent regulations in Scotland. You know, arguably, it was the only way that you're going to up the supply, but yeah, very effective. Behind the scenes, there's been a lot going on. I suspect the politicians are relatively supine because there's just not much of it. It's such a small proportion of the total private rented sector. I think we probably just want to get stuff built. The bigger question is in the long term, if we are shifting from, you know, the last Australia UK housing network meeting had that kind of critical junctures framing. If we're shifting from a homeowner society to some other sort of balance between tenures, and obviously historically no one has had the slightest sort of sense of what the ideal balance would be. But if we're going to shift to a bigger private rented sector, then you would begin to think about how you want to frame this, what proportion you want to be institutionally invested, what proportion you want to be small scale private landlords. And I guess at that point, governments become more interested and more active in that. And in both Australia and the UK, we feel like we're at kind of a similar point in this. There's still a kind of just let it happen attitude from governments right now.
Okay, thanks very much, Phil. I'm conscious that time's ticking on, but we have a question from Shah. If you'd like to.
Thank you, Mark. Can you hear me?
Yes, yes.
Thank you very much for the two great presentations. I really enjoyed that. And I think my question, it's not a question, it's just like join the discussion. Because I also noticed that in both countries, the institutional investors, the investors are generally international, over the global investors. So it seems that they just make the gain, they just make profits, and they leave more young people to pay higher rents in the build-to-rent housing market. So my question is that we are generally in the post-home ownership society, and but we're still in the welfare asset-based welfare society. So does that mean in the future the young generation, how can they survive without the assets in the future? How can they survive in their older age? And do you think there's still housing pathway for them moving from the current renting to home ownership, but because they are paying much higher rents to build to rent housing, especially those young professionals. But do you think they still have the chance to move to the housing ladders to have the ownership in the future? So that's kind of the things, and maybe just to want to discuss with you guys. Thank you.
Okay, thanks for the question. Because of time, could I suggest that we have one answer from Australia and from the UK, and if you could also include any kind of final comments you'd like to make when responding to Shah's question. So Rupa, do you want to go first?
It's a very good question, Shah, and a different project. The Precarious City project with Lawrence and Bill also posed this question. We were looking at more precarity in the housing market and labour market. And we asked young people what their sort of aspirations were, and majority of them did talk about their housing aspirations to own a home one day, but it wasn't necessarily through a mortgage of their own. They were relying on their inheritances, that wealth being passed on from previous generations. So there will be a divide that emerges, which many researchers have talked about, those who can inherit that familial wealth. But then there will be others that choose not to own a home and invest in real estate investment trusts or Bitcoin or alternative asset classes, private, equities, and don't necessarily want to take on that debt. We had a component of our millennial respondents survey, as well as interviewees, talk about not wanting to take on a big debt burden, and that their previous generations had. And maybe this is normalizing renting is what's needed in Australia as an alternative pathway. In Australia, very much, that ideal of home ownership has been created by government, and there's a cultural factor as well. And the millennials we spoke to talked about that's this pressure to own a home thrust upon them by their parents or their grandparents or specific cultural groups as well, despite their own separate preferences. So we'll wait and see what happens. But yes, there will be a divide, an intergenerational divide, and our taxation and superannuation policy, I suppose, needs to adjust to account for the fact that there will be fewer young people who will be able to own a home by the time they retire.
Okay, great. And someone from the UK team.
Can I just echo, I suppose, what Rupa said about the sort of cultural norms in the UK about home ownership and how, you know, we've got this generation rent scenario at the minute where it is taking a lot longer to pull deposits together to buy your home. And again, it is this drive towards home ownership, whereas other countries in Europe, like the Netherlands and Germany, for example, long-term renting is much more typical. And, you know, it's sort of, I would say that I would use the word accepted, but normal, I suppose. Whereas in the UK, it's kind of this, it's a different cultural approach to the way that you engage with the market, you know, and if you don't own, then, you know, it's like, well, why don't you own? You know, but there are other incentives out there and support mechanisms through the government. So L&Q, that landlord that I mentioned earlier, they do what they call a rent to buy scheme. So if you're paying reduced rents, then a proportion of that gives you space and capacity to then take the money that you're saving to then put towards purchasing in the future. And we have had help to buy schemes in the UK, especially in London, where it's so overheated. But to me, that just perpetuates the issue, and it's not really the government addressing a structural shift in the market. It's just sort of enabling shifts, very small shifts over a longer time frame into home ownership, and it's maintaining that home ownership kind of mentality and dynamic in the market. So yeah.
Okay, thanks very much, Nicola. We keep these events to an hour and a half, so our time is come to an end. But I think it's been a very interesting and stimulating discussion. I'd like to thank the speakers and all of you for attending today. And thanks also to Callum Thompson of Cash for organising the event, although I was responsible for the time confusion. We're planning one more event this year on intermediate tenures. It's provisionally scheduled for the 27th of November, so do keep an eye open for the notifications. Callum will turn the recording off in a moment. Perhaps the speakers and Secretariat could stay online just for a quick debrief. Meanwhile, I wish you all either a good evening or a good day. Thanks very much.
Thanks, Mark.
Thanks a lot, guys. Bye.
Thanks.